Hi all, my name is Adnam El-Araby. I'm going to be talking about the Barings Emerging Opportunities Fund, which focuses on the EMEA region of emerging markets. So if you look at the map here, these are the countries that encompass the traditional global emerging market index here. When people speak about emerging markets, they're normally talking about EM Asia, which makes up over 70% of the global emerging market benchmark. It's no secret that China is the largest country in Asia, but also the second largest economy after the US. Second, you have Latin America, which is about 10% of the benchmark. And you have two large countries, Brazil and Mexico, and a long tail of smaller countries. And obviously that region benefits from its close proximity to the US. And the region that I'm going to be talking about today, and the region that the trust is focused on investing in, is EM EMEA. And the first thing that you could see here is a geographical span of this particular region, where you basically have three distinct regions, right? The Middle East, in the middle here, has completely different culture, different history, different economic backdrop than emerging Europe, which benefits from its close proximity to the EU, and probably less so to Russia. And then on Africa, it's a completely different, again, culture. And within Africa itself, it's very diverse. You know, South Africa is a completely economic story versus, for example, North Africa in Egypt, right? So if I can, so like I said, the geography, and one thing to highlight, these are the countries that are in the benchmark, but we're not restricted to the benchmarks. We invest across the entire region in any country or any company that we see and deem opportunity in. Okay, so the first thing in the Middle East, when everyone says the Middle East, the first thing they think of is the oil price, right? But the value of most public assets in the Middle East are actually much more correlated to the US dollar than to the oil price, right? And so that's not to say that the oil price is irrelevant, but whether the oil price is at 70, 50, 80, or 100, it's less impactful on the valuation of the public assets. And the reason for that is that over the past 5 to 10 years, but specifically over the last 5 years, we've seen a conscious decision by the governments in the entire region to keep the pace of capital investments very, very high in order for them to push through the economic and social reforms that are needed for the economies to actually evolve and the societies to also continue to reform. Don't forget, you have a very young population. Over 50% of the population is below the age of 40. Okay? Western educated. And these reforms are starting to come through. I mean, things, very simple things like digitalization of society, the ease of government services, digitalization of government services, healthcare, mandating health insurance for all workers, white collars and blue collars, right? And what we're seeing here is then, okay, well, if oil price is at 50, let's say oil price drops, the OPEC plus policies are removed, what happens then? Well, a lot of these countries have huge reserves, so they're able to continue to invest in those economic reforms, and those capital investments have remained high despite the volatility in the oil price over the last 4 or 5 years, right? So you're able to borrow at a much lower rate. Don't forget also, a lot of these sovereign wealth funds have they themselves now become institutional investment managers on the private side, but also on the public side. And what they're doing is actually they're mandating a lot of the government-related entities that are public to have more efficient capital allocation, which means better balance sheets and higher dividends. So you're funding the deficits through higher dividends, but also what you're doing is that they're reducing the subsidies. So a lot of these sort of government-related traditional industries, for example, petrochemicals, when they were first introduced, to make them more competitive, they gave them free input costs, right? So free products for them to actually generate other products through the value chain. But the reality is that when you give something free money, you don't become efficient. You don't become competitive. You become inefficient, right? So you're killing two birds with one stone by reducing the subsidies, increasing the government entities, and making the industry a bit more competitive. Thirdly, the tax lever now has finally been pulled. So in that part of the world, we didn't have corporate taxes, income taxes. Subsidies were high. Now we're seeing a huge transition into lower subsidies, ensuring that the health burden is actually put onto the private sector. So if you want to operate in Saudi Arabia, if you want to operate across the region, you have to provide your workers with health insurance. And don't forget here, a lot of the economic backdrop is very supportive. You have the lowest inflation rate globally, you have low unemployment, and we're seeing a big buy-in from society itself. Labor participation rates are very high and continue to actually grow. Immigration into that region is also continuing to grow. Now, if we move on to emerging Europe, completely different history, completely different society and background, but similar demographics. You have a young population, very well educated, strong in mathematics, and really emerging Europe has really been, over the last few years, been coming out of the effects of the pandemic, but also the Russia-Ukraine conflict. You're seeing inflation come down, food inflation, energy inflation come down, and wages growing above inflation at a rate much higher. So consumption is very strong. We put Turkey in here, and a few investors have asked me about Turkey. And Turkey really straddles the best of both worlds in both regions, where you have an open society, so tourism is high. You have a very young population, highly productive labor force. You have a very deep public market, well-managed companies, and very strong management teams across the entire country. So there's a lot of opportunity, and you see these management teams operate in very volatile economic policies over the last decade, which we think is actually behind us now, and there's a lot of opportunity going forward. We put here nearshoring, but because obviously this is sort of a term that everybody's discussing now. Now, EM Europe is not going to be Mexico any day and will never be, but I think the world has made a conscious decision to diversify their supply chain, and I think all of emerging markets will have some sort of trickle-down effect to some sort of extent. Then Africa, again, completely different than the other two regions. Africa has always operated on its potential. So there's always potential in Africa, there's always opportunity, but the volatile economic backdrop, the politics, the diversity of the cultures doesn't make it an easy hunting ground. And there's a lot of risk and a lot of losses. So how do you square the circle here? You always have to bet on the management teams that know how to operate in whatever country they're operating in, and more importantly are the ones that understand their strengths and weaknesses, right? So a successful South African management team that understands that their strengths and weaknesses are not necessarily going to be successful in Kenya or possibly in North Africa, for example, in Egypt. Okay, this just brings to life a little bit more of the demographics that I highlighted and the economic backdrop for each region. Okay, so when we talk about EM EMEA, it's the second largest component of emerging markets. It's around just above 12% here. And because you have three distinct regions and unique regions, the correlation to China is very, very low, and the correlation to the rest of emerging markets is, again, below 0.7, right? So what you're looking here, there's a region that allows you diversity and complements your exposure to your global emerging market exposure, or possibly to your emerging Asia exposure, see? So EM Asia, for example, is very correlated to China, and obviously here it's 100% correlated to the benchmark because it encompasses more than 70% of the benchmark. Okay, now, the diversity and the uniqueness of each region is also a double-edged sword, right? So because you have three distinct regions, in order for you to actually apply resources to that region and cover it, becomes a decision of economics, right? So a banks analyst that covers the Middle Eastern banks will not necessarily just be able to pick up seamlessly in emerging European banks. You have to apply another analyst in order for them to put that there. Where, for example, if you're a LATAM banks analyst, you're looking at Mexico, Brazil, and the rest of LATAM in order for you to cover it. So this creates disadvantages, but also opportunities for investors that actually understand the market and understand where the opportunities lie within each market. Okay, so we put this chart in because when you first look at the benchmark EMEA, and if you just look at an ETF, the performance hasn't been great. Even if you look at a GEM ETF, the performance hasn't been great. And the composition of the EMEA is really dominated by traditional industries and very cyclical ones. So what we're trying to show here is that for a region that is less correlated to the rest of emerging markets in Asia and is less well covered, there is a case for active management if you're able to understand which countries, where the economic cycle, where you are in the economic cycle, and where you are in the business cycle. So for example, in 2023, emerging Europe was the star of the show. That's basically Greece, that's Poland, Hungary, even Turkey. And Greece, for example, was credit grade, went down to junk, and now it's back to credit grade. So there's always opportunity. In 2022, it was South Africa and the Middle East that actually managed to outperform EM and EM. And in 2021, obviously the Middle East took a much bigger role in emerging markets with China's sort of challenges around the pandemic and the sort of heightened geopolitical risk between the US and China. And I think that geopolitical risk may continue to be there if Donald Trump sort of returns to the White House. Again, over 3 years, what we're trying to highlight here is that there is opportunity in active management if there is an understanding of where the opportunities lie within each market. So take for example, Turkey. Turkey is less than 1% of the global emerging market benchmark, right? But it returned plus 80% over the last 3 years. That's in US dollars, right? And so a successful global emerging market portfolio manager is not only, it can only maybe dedicate 5% of his or her time to Turkey, because they need to, in order for them to be successful, they have to dedicate 80% of their time to figure out, to harvest positive alpha out of Asia. Where for us, even Turkey is very small. It's still small. It's about 6% of the benchmark. But we know the market. We've been investing in the market for over 20 years, and we understand which companies are able to generate alpha on a risk-adjusted basis. And one last thing about these markets is that they're internally funded. What does that mean? That means that most of the liquidity actually comes from local investors, whether it's sovereign wealth funds, pension funds, high net worth individuals. It's very much the local understanding of where the opportunities lie. So you have to kind of understand what each local market is thinking about and where the opportunity and the risks are. So in the UK investment trust, the last thing about it is that obviously alternatives are continuing to grow. It's a growing asset class. But from the equity side, about 9% of all the UK trusts give you exposure to EM. And within that, it's predominantly in Asia because, again, Asia is the second largest economy, which is China, the most populated, technology, advanced, and gems. And with EM, there's a lot less institutional investors looking at that particular market, and a lot less institutional investors looking across the 3 different regions. So you might see institutional investors looking at MENA, or institutional investors looking at South Africa, or possibly EM Europe. But to have the broader region is very small, and we're one of those funds. So the trust, which we refer to as BEMO, we're not saying that this replaces your global emerging market exposure or EM Asia. What we're saying is that this complements it. So you have a region that's less correlated to global emerging markets. You have a region that's less covered by the bulge bracket analysts. So there's opportunity there. And also from the institutional investment side, there's a lot less institutional mandates that are looking at that region. I'm happy to sort of report that we've been looking at the region now for over 20 years. We're the largest team in terms of AUM. We're about 1.6 billion, and the trust is part of that mandate. Our specific mandate is to outperform and generate positive alpha on a relative basis. And then we have paid a dividend. The trust has paid a dividend every single year for over the past 10 years, and we have done some share buybacks as well. These are just some of the companies that we invest in across the 3 different regions. The 2 things that one or both of them, or all 3 of them have in common is A, a strong management team. You need a strong management team that not only is able to execute on their strategy, but also are able to articulate and communicate it, right? And so be able to speak to investors and be able to tell you where the risks are. Because in emerging markets, it always operates on its opportunity and its potential, but there's always a lot of risk and there's always a lot of volatility. So most successful people in emerging markets will always understand the downside first before you actually invest. Lastly, the trust is managed by myself and my colleague Matthias Siller. The trust is part of a larger team. It's us and 2 more investors. The total AUM is 1.6 billion. We've been working together for over 15 years, and the team has been looking at this specific region for over 20 years.